Good day, everyone. Welcome to our focus session on mastering moving averages, a key to Forex success. My name is Ali, and I'm the head of training and education at Errante. So happy to be your host today. We are going to delve into the world of moving averages, an essential tool for Forex traders. Whether you are a beginner looking to get you started or an experienced trader aiming to refine your techniques, this session is designed to offer valuable insights for all levels of expertise. So before we proceed, if you can hear my voice and see the presentation without any issues, could you please confirm by using the raise hand feature or typing simply yes in the chat window, please? Okay, let's take a moment to ensure everyone is connected properly. Thank you for your cooperation. Very well. I would like to mention that this webinar is brought to you by Errante, the online broker committed to excellence in service and fostering lasting relationship with clients and partners. Before we delve into the world of moving averages and their crucial role in your trading success, I'd like to briefly highlight the importance of the information we will be sharing today. Please note that the insights and the strategies we discuss are provided for educational purposes only and should serve as a resource on your journey in the Forex market. Please don't take them as any kind of financial advice or trading advice or something like that. In addition, it's important to acknowledge that trading involves risks. Remember to consider these risks and conduct your own due diligence. For more information and resources, you can always visit our websites at errante.eu and errante.com. Now, with this consideration in mind, let's embark on our journey into mastering moving averages. As I said earlier, whether you are a novice looking to build a solid foundation or an experienced trader aiming to refine your techniques, this webinar is tailored to meet your needs. First, we will lay the groundwork by exploring the basics of moving averages from simple to exponential and weighted MAs. This foundation is crucial for understanding how these indicators work and can be applied across different trading scenarios. Next, we delve into identifying market direction using MAs. You will learn to decipher bullish and bearish trends and how this knowledge can significantly impact your trading decisions, ensuring you know when to enter or exit the market. Following that, we'll focus on the relationship between moving averages and market momentum, discover how to use MAs to assess the strength of market movements and utilize this insight to time your trades more effectively, enhancing your potential for success. And then we will cover analyzing the distance and slope of MAs. These concepts, let's say, can be a very key indicators of market reversals or continuations. So understanding these aspects will empower you to adjust your strategies in real time, optimizing your trade outcomes. Finally, we will tie everything together with practical application and strategy development. And this segment is where theory meets practice, showcasing real-world examples and case studies to illustrate how you can integrate MAs into your trading strategy for maximum benefit. And we will conclude with a Q&A session, as always, where I will answer your question happily and provide further insight to ensure you leave this webinar with knowledge and confidence to apply what you've learned. So let's get started on this exciting journey to mastering moving averages and transforming your trading strategies. To begin, we are focusing directly on what makes a trader successful in the Forex market. recognizing the correct trend direction, and finding enough momentum to enter a trade. These two elements are crucial for your trading strategy because they essentially tell you which way the market is moving and how strong that movement is. Firstly, let's talk about the importance of trend direction. Understanding whether the market is moving up, down, or sideways helps you align your trades with the overall market movement. And this is like knowing the wind's direction before setting sail. Yes? So you want to go with the flow, not against it. Now, onto momentum. This is about the strength behind the price movements. High momentum means the market is moving strongly in one direction, which is exactly what you want when you're about to enter a trade. And it's the difference between catching a small wave and riding a big swell. The stronger the momentum, the better the trade potential. So how do we use this in trading? Simply by combining trend direction with momentum. This combination allows you to filter out the noise and focus on high probability trades. It's like having a high quality filter for your trading decisions, ensuring you only take the trades with the best chances of success. Moving averages are your, let's say, go-to tool for this. And they help you smooth out the price data to easily identify the trend direction and gauge momentum. Whether you use simple moving average or exponential moving average, those tools are essential for making informed decision. And they're your compass in navigating the Forex market, guiding you to more successful trades by highlighting the trend's direction and the momentum strength. So what we will do in this webinar is that we are going to the well-detailed nuances of each of these features to extract the most information out of the moving averages applied on the charts. So, okay, building on our previous discussion about the significance of trend direction and market momentum in forex trading, let's dive into one of the most essential tools for identifying these elements. Simply, the concept of today, moving averages. Okay, so a moving average simplifies the market's price data by averaging it out over a certain period of time, helping to clear the clutter caused by volatility and short-term price movements. This gives traders a cleaner, more understandable view of the market's direction. We have several types of moving averages, each with its unique calculation and application. Starting with the simple moving average, or SMA, which calculates the average price over a certain number of periods. It's the most straightforward and widely utilized for its ease of understanding and effectiveness in identifying long-term trends. Then we have the exponential moving average, or EMA, which differs from the SMA by giving more weight to recent prices. This makes the EMA more sensitive to recent price changes, ideal for those looking to catch early signs of a trend shift. And also the weighted moving average and smoothed moving average offer alternative approaches, with the WMA focusing on particular time periods more significantly, and the SMMA, or smoothed moving average, providing a more comprehensive view by smoothing out price data over a larger set of points. We will also touch upon two other specialized types: the whole moving average, or HMA, and the volume weighted moving average, or VWMA, each serving specific analytical purposes to cater to diverse trading strategies. But before we delve into the let's say, nuances of these different moving averages, one might wonder, with the basic concept of a moving average being so straightforward, Why complicate matters with different types? The answer lies in the nuanced needs of traders and the diverse conditions of the Forex markets. Each type of moving average offers a unique perspective, enabling traders to fine-tune their strategies for more precise market analysis and decision making. For example, let's start by addressing the issue of market noise. Short-term fluctuations that can mislead traders about the true market direction. We all have faced it, I guess. Yes? So different moving averages filter this noise from different angles. The sensitivity to recent price changes. Yes, yes, I was saying the sensitivity to recent price changes varies among them. For example, the exponential moving average or EMA reacts more quickly to recent prices than the simple moving average, providing a sharper picture in rapidly changing markets. Moreover, the adaptability of moving averages to different time periods is crucial as well. Traders can set moving averages over short, medium, or long periods to match their trading strategy, whether they're scalping for small profits or making long-term investments. The period chosen directly affects how closely the moving average follows the price action. Next, the choice of price data used in the calculation, whether it's the opening, closing, high, low, or a combination like HLC or HLCC, offers further customization to our moving average. And this allows traders to create moving averages that best reflect their analytical focus, whether on the volatility captured by high and low prices or the finality of closing prices. Additionally, don't forget, employing multiple moving averages in tandem can unveil powerful trading signals, such as a golden cross and death cross that we will discuss later in this webinar, which occur when shorter period MAs cross over longer period MAs, and we can make it very great combinations that may work on a particular trading instrument. And this technique provides clear actionable signals by highlighting the points where market momentum shifts. And finally, the last but not least, moving averages are foundational elements of many advanced trading indicators and systems. Tools like Bollinger Bands use moving averages to measure market volatility, while indicators like the Alligator and MACD rely on them to identify trend strength and direction changes. So if you want to put one step further and maybe learn about those more advanced oscillators and indicators, you will definitely need to have a great foundation of moving averages. So let's focus on one of the most fundamental indicators, the simple moving average or SMA. The SMA offers a clear, uncluttered view of the market's direction over a specified period, making it an indispensable tool for traders aiming to align with the trend for successful trades. The calculation of the SMA is as straightforward as its implication in trading. By averaging the closing prices of a currency pair over a set number of periods, the SMA smooths out price fluctuations to present a clear trend direction. And this simplicity allows traders to quickly assess whether they are facing an uptrend, downtrend, or sideways market. But how do you decide on the number of periods? The choice largely depends on your trading goals and strategy. Let's say a 20-period SMA might be your go-to for capturing short-term trends, offering timely insights, for quick decisions. The 50-period SMA extends this view to medium-term trends, balancing responsiveness with a broader perspective. For a deeper, more stable understanding of market direction, the 100-period and 200-period SMAs serve as beacons for long-term trend analysis, with the 200-period SMA often considered a definitive indicator of major market trends. Incorporating the SMA into your trading not only aids in identifying the current market trends, but also helps in planning entry and exit points, managing risks, and also setting stop loss orders effectively. Okay, so we've learned SMA offers a solid foundation for trend analysis. However, a somewhat delayed response to market changes prompts the need for a more reactive tool, particularly in fast-paced environments. Enter the exponential moving average, a refined tool designed to keep traders one step ahead of market movements. The EMA distinguishes itself by emphasizing recent price data more heavily than the SMA, thanks to a unique component called the smoothing factor. This factor is crucial as it directly influences how much weight recent prices carry in the EMA calculation. Uh, it's calculated as 2 divided the period plus 1. The smoothing factor, we call it smoothing factor, it's here to ensure that the EMA adjusts more rapidly to price changes, significantly reducing the lag associated with traditional moving averages. So this heightened sensitivity of the EMA offers a trio of advantages for traders. Firstly, its ability to react faster to price changes makes it indispensable for capturing the initial stages of a trend or a reversal. Secondly, by minimizing the lag, the EMA provides a more accurate reflection of the current market state, allowing for more precise trading decisions. Lastly, in volatile markets, where prices can swing widely and quickly, the EMA's responsiveness enables traders to navigate these turbulent waters with greater confidence, potentially leading to better outcome. Next, let's encounter the weighted moving average, a nuanced tool that enhances our market analysis by offering a distinct approach to weighting price data, the WMA, which is designed for traders who seek more sophisticated analysis, focusing intensely on the most recent prices, but with a unique twist in how these prices are emphasized. This is the specific difference between the EMA and WMA. Unlike the EMA, which uses an exponential formula to assign weights, the WMA applies a linear weighting to the price data. So this means that each price points between the period is multiplied by a weight that increases for more recent prices. This method not only emphasizes the importance of the latest market information, but also allows for a more tailored analysis through customizable weighting strategies. It's this precision and flexibility that set the WMA apart, particularly when examining short-term trends where the latest, let's say, price movements or of paramount importance. The advantages of the WMA become evident when compared to its counterparts, the SMA and EMA. Against the SMA, the WMA stands out for its ability to provide a closer, more immediate reflection of market dynamics by bypassing the lag that often accompanies simple averages. Compared to the EMA, the WMA offers an alternative by allowing analysts to specifically tailor the weights applied to the prices, providing a different perspective on the market's direction. Okay, so incorporating the WMA into your trading strategy means engaging with the market on a level that emphasizes precision and recent trends. This approach is particularly valuable for those looking to capitalize on short-term movements, as it ensures that your analysis is grounded in the most relevant and current data. Okay, in our exploration of moving averages, we have covered the commonly used types like the SMA, EMA, and WMA. However, the world of trading analytics offers even more specialized tools like with unique formulas and optimal conditions for use. Let's dive into three such moving averages: the whole moving averages, the HMA, the volume weighted moving averages, and smoothed moving averages. Each of these indicators is tailored to provide unique insights into market behavior, equipped with specific formulas that enhance their analysis. Let's start with HMA. The HMA stands out for its innovative approach to combining the advantages of various moving averages. It offers a formula that significantly reduces the lag. This is achieved through a clever calculation that effectively doubles the weights of the moving average's midpoint, subtracting the lag of the longer period to provide a smoother, quicker line. So this makes the HMA an excellent choice for traders looking to keep pace with rapidly changing market conditions, offering clear signals for when to enter or exit trades. Let me just mention this, that by default, you can find the SMA, EMA, WMA, and SMMA in the in common trading platform like MetaTrader 4 or 5, but to apply the HMA or the more advanced ones like VWMA, you need to maybe search a bit to find the indicator, and then you need to install it separately on your MetaTrader to be able to use it. Okay. Okay, let's continue with VWMA. In contrast, the VWMA incorporates volume into its calculation. It's more complicated. It provides a weighted average that considers not just price movements, but the volume of trades behind those movements. This formula ensures that periods with higher volume have a greater impact on the moving average, making it a critical tool for assessing the strength behind price trends. And it's particularly useful for spotting breakouts or reversals, where volume plays a key role in confirming the move, especially in stock markets. That we have got through the difference between the concept of volume in Forex and the concept of volume in stock trading many times in our previous webinars. Yes, so this is the volume weighted moving average, or VWMA. As you see, we pointed out the formula here is the sigma of the price multiplied by volume and divided by the total sum of volume, okay, over n periods of time. And then we have the SMMA, or smoothed moving average, which is formula focusing on a longer term perspective, gradually incorporates new price data while maintaining a smooth line that filters out short-term volatility. This moving average is particularly suited for traders who base their strategies on the somehow overarching direction of the market, those require a stable and reliable indicator that reflects long-term trends. By understanding and applying these specific formulas, HMA, VWMA, and SMMA, traders can equip themselves with a nuanced view of market dynamics. Okay, guys, it's important to know that each moving average serves a unique purpose, whether it's offering speed and precision with the HMA, or depth and confirmation with the VWMA, or stability and continuity with the SMMA. So integrating these tools into your trading strategy can open new avenues for analysis, helping you to make more informed decisions and capitalize on market opportunities with greater confidence. But for those who might be new to applying these tools, let's take a look at MT4. You see here I have a chart. Let me just clean it up a bit and then reapply all the moving averages again together. When you want to apply the moving average, you can find it through the navigator or using the insert menu here. You can find the indicator and you can find the moving averages. In both cases, you will be able to choose from the different features that make you to apply any type of moving averages you want on your chart. Firstly, you see this window just pops up, and then here you can choose your period, and then you can choose the method of calculation. That, as you see here, we have only the 4 types of moving averages discussed together. Simple, exponential, smoothed, and linear weighted. And then you can choose the price. The base of your calculation is going to be the data database that the MT4 is going to use to calculate your moving average. Okay, it can be close price, open price, high, low, or medium price, etc. And then this is an appearance just setting that you can set them any color, any length, any type of line, and everything you can choose. And the thing is that, for example, let's try a simple moving average with 100 period applied to close price. You see this line. This line means that the simple average of the close price of the last 100 candles is this one. That if you open a data window here, you can find it, the MA, and for example, you see it's 1.07696. Okay, so let's try a different one. For example, exponential. I'm going to change the color to give it a better appearance. And now you see the exponential moving average is almost in the same shape of the simple moving average, but a bit closer to the price. If I zoom it out, you will see that during significant market movements, this exponential moving average is usually closer to the price. So then try the other one. This time go for linear weighted. The linear weighted, as we mentioned, is usually it emphasizes on the most recent prices boldly. So we expect it to be more sensitive to price movements. And as you see, when we apply the 100 linear weighted based on the market movement, after getting some, let's say, momentum in the price, you see it gets closer to the price. And during each reversal, the linear weighted moving average is the first one which the price crosses below or crosses above it. And then the last one that we are able to apply in MT4 is the smoothed moving average. And the smoothed moving average is expected to be smoother than the simple moving average. So let me choose a color for that. Maybe, I'm not sure, maybe this one. Let's shoot this. And yes, and you see here is a smoothed moving average, and it's the smoothest one during the market fluctuations in the far distance compared to other moving averages on the chart. For example, during market trend, you can see we have respectively the smoothed moving average, and simple moving average, exponential moving average, and then linear weighted moving average. So linear weighted moving average can be used to identify the initial effort of market uh, buyers or sellers to reverse a prior trend, okay, by crossing the linear weighted moving average. But the one that usually shows the general direction of the market is the smoothed moving average. So you can choose between different moving averages based on your purpose of uh, your use, or let's say it depends on what information you're gonna extract from the market that can help you to make a better trading decision. Very well, so let's move forward choosing the right moving average and talk about this criteria for the optimal MA in trading. In the pursuit of integrating moving averages or MAs into trading strategies, the paramount uh, is for selecting the most suitable MAs is its reliability in reaction to price movements. This reliability is observed through an MA's ability to consistently serve as robust support in uptrends without prices closing below it, and as a strong resistance in downtrends where it prevents candle closes above. This characteristic is fundamental in identifying an MA's effectiveness for trading. Next, the balancing act between the duration of an MA and its responsiveness to market changes is crucial. Longer MAs, while offering a dependable view of the market's um, overarching trends, might lack in reflecting rapid market shifts. So their strength lies in smoothing out volatility, providing a clear picture of long-term market direction. However, this comes at the cost of immediate responsiveness. So you need to make a balance between these two features. On the other hand, the sensitivity of shorter MAs, particularly weighted moving averages, for example, to market fluctuations, presents an advantage for those keen on capturing quick market movements. The agility of WMAs in adjusting to price changes makes them valuable for strategies that rely on swift entries and exits based on short-term price dynamics. The quest for the most effective MA requires a nuanced approach, seeking a balance between the length of the MA for overarching trend reliability and the need for sensitivity to detect timely market adjustments. This equilibrium ensures that the chosen MA not only signals the primary market direction accurately, but also identifies potential entry and exit points with efficient promptness to capitalize on trading opportunities. Furthermore, the alignment of the MA with one's trading style cannot be overstressed. Please consider, while long-term traders may find solace in the stability offered by longer MAs, short-term traders might prioritize the immediacy provided by shorter, more sensitive moving averages. And this alignment is pivotal in crafting a trading strategy that resonates with individual trading objectives and, let's say, market perspectives. Okay, so an effective MA proves its worth by upholding its support and resistance rules across varying market scenarios, thereby maintaining its reliability as a trend indicator. This ongoing validation against historical and real-time market conditions ensures that the chosen MA remains attuned to the trader's needs, offering a blend of reliability and responsiveness essential for navigating the Forex market's complexities. So the most effective moving average is one that's, we can say, is the one that embodies a steadfast relationship with price action, marking itself as an indispensable tool in the trader's arsenal by providing unwavering support or resistance, all while staying responsive to the market's immediate movements. For example, if you look at the chart here, if you want to choose I have the Euro USD, let's go to the, for example, H4 time frame. If you want to choose the best moving average, you need something very close to the market. In that case, you have the linear weighted in this case, or the exponential moving average, or even a simple moving average. But we might prefer to somehow leave this smoothed moving average out of the chart. So in that case, we need a moving average and a reasonable period that can reflect the price movement as fast as possible and as accurate as possible. So in that case, you see, for example, we need to see a good reaction to each market movement. In that case, you see the linear weighted moving average can point out many different resistance levels, like here, like this area, somehow. So we might consider it as it's closer to the price as a more reliable indicator in this case. But maybe in the other time frame, we might be able to choose another type of moving averages. For example, in this trend, you see the simple moving average upholds a very solid, let's say, supports level here, but it's a bit far from the price. So we can't make our trading decision based on the simple moving average. We can just use it to get the sense about the general direction of the market. But to get a better signals, maybe a trader might prefer a linear weighted moving average. So it all depends on your time frame, on the trading instrument that you want to trade, and also the strategy you're gonna to let's say get your trigger to enter the market or exit the market. So based on that, you have to go through the chart. You have to put different periods on your chart and use a different methods to find the most reliable one to the price action. For example, in 50 exponential moving average, I can see it's really reliable in the case of Euro USD. Yes. Or maybe you prefer something shorter like the 34, and in that case you might like to go for linear weighted, and this is my favorite MA to use because you see it's always reliable about the market trend, but because it's too close and too sensitive to price action, you should always compare it to the other type of moving averages or other length or periods, because you might get a very uh, immature, let's say, or premature signals like here. Okay, very well. So the incorporation of moving averages into Forex trading uh, bestows traders with a powerful toolkit of navigating the markets. The essence of utilizing moving averages lies in the wealth of information they provide, uh, offering insights that are critical for planning trades under diverse market conditions. Let's explore the broad spectrum, let's say, of rules that or roles of moving averages fulfill, laying the ground for a deeper understanding of each function is subsequent discussions. As the core, MAs help in identifying the direction of trends, whether short-term or long-term. This ability to gauge market movements is foundational for any trading strategy, as aligning with the trend significantly enhances the probability of successful trades. Moreover, moving averages play a crucial role in distinguishing between short-term market corrections and the beginning of new trends, or let's say major reversals. This distinction is vital for traders to avoid premature entries or exits based on temporary market fluctuations. Another key function of moving averages is acting as dynamic levels of support and resistance. Unlike a statistic, or let's say uh, unlike the static levels or price levels, these dynamic boundaries adjust with the market, providing real-time insights into potential reversal points or breakout opportunities. Momentum measurement is another essential role of MAs. By analyzing the distance of price from MAs and the slope of MAs, traders can gauge the strength of the trend, allowing for more informed decisions regarding entry and exit points. The interpretation of MA crossovers offers another layer of analysis, where the crossing of two MAs can signal potential shift in market dynamics, offering cues for traders on forthcoming movements. Lastly, the crossover between price and MA serves as a potent signal for market entries or exits, uh, marking instances where the market sentiment might be shifting. In sum, the multi-layered roles of moving averages provide traders with a comprehensive framework for analyzing market conditions, identifying trading opportunities, and managing risks by hinting out the setting of a stop loss and take profit levels. As we delve into each role in more detail in the following slides, remember that the power of MAs lies in their uh, versatility and the strategic depth they add to forex trading, enabling traders to navigate the markets with greater confidence and precision. Okay, uh, as we're getting short out of our time, uh, let's discuss crafting trading signals using moving averages. In the pursuit for effective buy signals within the Forex market, moving averages stand out as pivotal tools guiding traders through the nuances of market entry points. Okay, so the process begins with identifying an uptrend in a higher time frame, establishing a backdrop, let's say, for potential buying opportunities. And this step ensures that we are aligning our trades with the market's general momentum, a strategy that typically enhances the probability of success. Once an uptrend is confirmed, the next step involves zooming into a lower time frame to spot corrections that move against this uptrend. For example, here we have a daily time frame and you see a change in market's momentum here, and we see the let's say cross above the shorter MA first, and which is the 50, and then the 100 WMA, and then a trader might look for buying signal here above the both moving averages. Okay, in that case we can see the emerging of a new uptrend in the market if we have a successful close above the last major top at this level. So once an uptrend is confirmed, next step involves zooming into a lower time frame like H1 as you see here. And the art lies in waiting patiently for these corrections to complete, which can be somehow shapes can shape a candlestick patterns indicating a reversal or a rebound from an moving average. For example, you see I zoomed out this level here, and you see this, for example, pullback to a short moving average on a shorter time frame can give us a buy signal, buying at the lowest possible level. And then we see another one here, and by non-confirming candlestick to the upside, just opposite the previous one, above, crossing above the long moving average in this H1 time frame, we can get a confirmation to go into the market, but in general direction of the higher time frame, because we want to trade based on daily time frame, not the H1 time frame. In that case, we can enter into a buy position as we looked at this level here. This is our trigger signal at this candle, and the next day gonna be our confirming candle. So the art lies in waiting patiently for these corrections to complete, which can be somehow shape a candlestick patterns indicating a reversal or a rebound from an MA, as you see here. The precise moment of turnaround is where the opportunity for entry lies. Two primary signals can then be used to initiate a buy. The first signal emerges when the price crosses above an MA in our let's say original time frame that we're gonna trade. I mean the daily time frame. Okay, this is the first signal, emerges when the price crosses above an moving average, signifying that our momentum is picking up and the correction phase may be ending. The second signal is observed when the price pulls back to the moving average, being short or long time frame doesn't matter, and then rebounds, confirming the strength and continuation of the trend. As you see here, this is a second buy signal with a price pullback to MA. The advantages of this method are clear. It allows traders to capitalize on the strength of the underlying trend while offering a structured approach to timing entries with greater accuracy. Moreover, by waiting for corrections in lower time frames, traders can enter the market at more favorable points, potentially maximizing their gains, also minimizing the risk. However, this method is not without its limitations. Please consider this fact that the challenge often lies in the timing, identifying the end of corrections, and the start of rebounds requires a keen eye and experience in reading market signals. Furthermore, external market factors and volatility can sometimes disrupt the expected flow of price movements, leading to false signals. So you have to always check it with the other confirmations coming from the other tools, like the oscillators, for example, momentum oscillators, something like that. And now let's go through uh, selling signals in the, let's say, counterpart to buying strategies within forex trading. Moving averages similarly provide a robust framework for generating sell signals. The journey begins with the identification of a downtrend in a higher time frame, setting the stage for potential selling opportunities. And this foundational step ensures that our selling strategy is in line with the broader market movement, a practice that generally improves the probability of success. And following the detection of a downtrend, the strategy involves zooming into a lower time frame to identify rallies that move counter to this trend. Uh, Look at the example here, please. The critical element here is patience, waiting for these rallies to culminate, as evidenced by candlestick patterns maybe that suggest a reversal or a fall from a moving average. And these moments signal the optimal points for market entry. You see, we detected a new downtrend here after crossing below the shorter moving average, and we maybe wait for completion of the crossover from the longer moving average, let's say, and then we can just show them on the H1 or a shorter time frame, see if we can have a correction or a rally through this fall down here. And then we can spot entry for sell, opening a sell position. Similar to the buy signals, there are two primary sell signals in this strategy as well. The first emerges when the price crosses below an MA, indicating that the downtrend is regaining strength and that the rally may have ended. The second signal is observed when somewhere here, when the price rallies to an MA, whether short or long doesn't matter, and subsequently declines, reaffirming the downtrend's persistence. So usually experienced traders open part of their position here and then wait for a new confirmation or a further confirmation at this rebound from the moving averages, and then they open the rest of their position based on their risk management and risk calculation at this point, after seeing, for example, this bearish candlestick pattern here. So in this case, you can generate two types of signals, and you can just allocate your position size based on to diminish, let's say, the unexpected risk, and stay with the market in a general trend and general direction of the market. And this is the one of the advantages of this method. That said, the advantages of employing this method are evident. It enables trader to capitalize on the continuity of the downtrend providing a systematic approach to timing market exits or initiating short positions by let's say exploiting the end of counter trend rallies. Traders can enter the market at points that potentially maximize the efficiency of the trades as well. However, the method's limitations again must also be acknowledged. The timing of rally conclusions and the initiation of declines demands acute market insight and experience. Additionally, external market dynamics and volatility can sometimes lead to misleading signals, necessitating a cautious approach. In that case, you need to use the further confirmations in the other oscillator or indicator like RSI, like let's say Austin oscillator or something like that. Very well, I guess we get to the end of our today's session talking about the moving averages. It was the first session. We discussed the basics of moving averages. We will have another session later next month exploring the more advanced features of moving averages to engage precisely the market's momentum and the exhaustion of the trend to measure, to gauge when we can enter against the trend, the current market, let's say, direction. Very well, that was for today, guys. Thank you so much for staying with me this long, and I wish you a great evening. Thank you. Hope to see you next Monday.